Before the economic liberalization of the 1990s, India was often on shaky ground when it came to foreign exchange reserves. Like in 1960, forex reserves covered just over 8 weeks of imports. In 1980, it soared to $7 billion. But in 1990, it depleted again and covered just over 4 weeks of imports. And there were restrictions on remitting money abroad too. The reasons for keeping the outward remittance in check included protecting the Indian rupee from destabilization and devaluation, and ensuring a healthy cushion of foreign exchange reserves to fulfill the import and other financial responsibilities like debt repayment. But things changed after the opening of the economy in the early 1990s. And in 2004, the Reserve Bank of India came out with the Liberalized Remittance Scheme, or LRS. The scheme allowed Indians to send up to $250,000 in a financial year without any approval from the central bank. As their wealth grew, Indians started remitting more and more money abroad. According to RBI, outward remittances under the LRS stood at $22.08 billion during the April-January period of FY23. LRS allowed both capital and current account transactions. Capital account transactions like opening foreign currency bank accounts abroad, acquisition of immovable property abroad, overseas direct investments, overseas portfolio investments, and extending loans to relatives abroad became permissible through LRS. Also, transferring money for education, traveling, medical treatments, and donating money overseas became easier. So far, 5% tax collected on source, or TCS, is levied on all remittances above the threshold of 7 lakh rupees. In the FY24 budget, the government has now proposed a 20% TCS. The remitter can reclaim the excess tax when the income tax return is filled, but for a while, the money will remain locked in. Over the last 2 decades, the outflow of remittance from India has been on the rise. A lot of individuals have been sending money abroad every year to invest in cryptocurrencies and gain through the differences in interest rates through fixed deposits in foreign banks. Against this backdrop, RBI has also issued a circular saying any money that has been remitted overseas and remains unutilized for more than 180 days needs to be repatriated back into the country. They are required to invest the unused remitted money in foreign securities, mutual funds, properties, and other assets.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.